There's a quote that's been stuck in my mind for the last week. And to me, it's so poignant. Poignant? And I want to share it with you. The quote is: "We don't rise to our level of expectations, we fall to the level of our training." And I wanted to look up the word expectation, as I often do, because it's, of course, expectation, what we're expecting about the future. And as I look up the definition of expectation is our great belief, or a belief that we have about the future, a belief that we have how the future will turn out, right? We have this certain belief how the stock market will act in the future. We have this belief. So our money doesn't grow to the rise of our beliefs, right? Our money doesn't accelerate to the rise of our beliefs about the future. I'm just taking out the word expectation, right? Our life does not rise to the level of our expectation. Our stock money, our investments don't rise to the level of our belief about the future. It falls to the level of our training. So what is your training? I mean, deliberate training, not what you learned from the big box advisors and you learned their questions to ask, not your questions. What are the right questions? And what I find people find out over time is, oh my gosh, my training was about aligning my money to the big box, the conventional advisors, the billion-dollar pick of the month newsletter industry. And in fact, I've actually never really been trained with a huge dose of understanding my own biases, how I'm going to fool myself. Of course, you guys are going to fool yourself. We all fool ourselves. To think you won't fool yourself is a foolish way of thinking about it. So with that, I want to share something that's been true about myself for 20 or 30 years. And I've been wanting to do a blog post like this for some time. Hey everybody, this is RC Peck, and this is my weekend podcast. It's so good to have you here. And I want to show you this image right here. It's actually not an image. It's a bunch of letters and words and symbols. The symbols being the percentage sign and some dots. And because I have a dyslexic brain, and just hold on for a second, guys, as I'll describe what we're looking at in a moment. But because I was born with a dyslexic brain, and my sister has a dyslexic brain, and my dad has a dyslexic brain, and my son has a dyslexic brain, I had to really rely most on my pattern recognition. A dyslexic brain today is called a 3D brain. And this is something kind of funny. When we learned, I think it's kind of funny. When Burgess and I learned that Bowen had a dyslexic brain, Burgess bought all these books. And she said, "Would you please read these?" And I was like, "No, because it is exceptionally difficult for me to read numbers and letters and words and sentences and paragraphs. Dyslexic books only work if the parent is not dyslexic, so they can read about their son or daughter's dyslexia." So there's a pile of 10 books that I have never opened. I think that's kind of funny. So look at the screen here. So I want to show you how a lot of people think about investing. A lot of people think about investing with letters and numbers, or words and numbers. And whether it's a price to earnings ratio, or a price to book ratio, or a price to sales ratio, or a price to cash flow ratio, or a cyclically adjusted price to earnings ratio, which is often known as a Shiller PE ratio, a cap ratio, or a dividend yield, right? These are words, these are terms. And then we're taught to look for these, and then let's look at the numbers. So you may not know what these are, and these may not be numbers that you follow. Certainly if you follow me, you probably don't, which is fine. But let me just point out some of the best numbers. And first, notice that the United States has not won any of these. It doesn't have the best price to earnings, price to book, price to sales, price to cash flow, cap ratio, or dividend yield. None of them. I've put a rectangle around the best. So with Europe is tied for the best price to sales, right? It has a 0.9. So does Asia have a 0.9. And Europe, so really the only one Europe really won was it has the highest dividend yield. And so what humans will do, what investors will do, is they go, oh, I need yield. I need dividend yield, so I'm going to go buy Europe, right? And this makes sense to their brain because they see this number, they read the words, and they go, highest dividend yield, that's good, that's safe, I'll go get it. Or they might say, well, I want the best price to book, the best price to sales, the best price to cash flow, the best price to earnings, which is emerging markets, and the best cap ratio. Now, I want you to know that Asia and the emerging markets, they're pretty much the same thing. I mean, they're pretty much the same thing. So really, as we look at this Asia emerging markets based on letters and numbers or words or phrases and numbers, one would believe, an investor would be led to believe, could be framed to believe, hey, you've got to have some of your money in Asia. Most of the emerging markets on the planet are in Asia. So I'm just going to call it Asia from here forward. You got to have your money in Asia. And the investor would go, yeah, you're right. Because they've been trained to read words and phrases and learn what they are and look at the numbers. They've been trained. So we fall to the level of our training. Now, people don't get that this is happening. Now, what I want to show you is something different, because the way I had to train myself, because I have dyslexia, is I trained myself very differently. I could not train myself with letters and numbers because my brain was like, I don't know what that is. So I had to train myself differently, which I'll get to in a minute. Now, I'm going to look at Asia. Let's go look at Asia here. So here's a price chart of Asia. This is a Vanguard ETF. And you can see from the beginning, basically, of 2016 until today, Asia's doing great. So visually, you might go, RC, well, now we're talking visually here, but visually, RC, Asia's doing great. And I'd say, yeah, it was doing great here, it was doing bad here, and overall, I'm looking at this and going, I don't know. But let's just stick with me saying it's doing great. The next thing I do, and this gets back to you fall to the level of your training. The next thing I do is I say, okay, well, what does it look like compared to the free market rate of return? And this is an RC definition. To me, the free market rate of return is the S&P 500 with dividends reinvested, right? Because if you compare that against the 30-year Treasury, and some people call the 30-year U.S. Treasury a free rate of return because the U.S. government has always paid their bills for 240 plus years. But let's for a second call the S&P 500 the free market rate of return. And so my question is, well, is this beating the free market rate of return? Because if it's not beating the free market rate of return, then what am I doing in it? It's not a smart move. And so this price chart right here is the same time frame, looking at 2 years. It's just comparing that Asian ETF fund against the free market rate of return. It's simply saying, hey, if the line is going lower, that means Asian stocks are underperforming US stocks, right? So I'm not looking at numbers right now. I'm not looking at letters. I'm looking at an image. I'm looking at images. And guys, of course, the nuance, the devil's in the details. What images do you look at? And there's 4 specific images I look at in a specific order. And we don't have time to get into this, but there's 4 images I look at, and those 4 images tell me everything. And you can look at those 4 images and immediately know whether that investment's a go or a no-go. Now, if I zoomed out, right, because we're only looking at 2 years here, but if I zoomed out, now look at this. This is 1, 2, 3, 4, 5, 6, 7, 8. We're looking at 8 years of data where we're comparing the Asian market to the free market rate of return, again, which is the S&P 500 with dividends reinvested. And look at this, for 8 solid years, it's underperformed. Now, I bring this up because for 8 years, whether it's been emerging markets or it's been the Asian market, people who only think in letters and numbers say, hey, it's got a better price to earnings ratio, it's got a better price to sales, got a better price to whatever, got a better price to whatever. And so people go, oh, yeah, that's what we got to get into because it's got better letters and it's got better numbers. But what you want to do is you want to turn on a different part of your brain, right? You want to turn on the part of your brain that can see the information. You want to turn on the pattern recognition part of your brain, because when you do, you see everything. So what I had to figure it out on my own. But look, do you want to look at pictures or do you want to look at numbers and letters? And just think about a couple things here. Almost 50% of your brain is involved with visual processing. So, like 50% of your brain was designed to look at patterns. We are a pattern recognition machine. We are a pattern recognition machine. And almost 50% of our brain is dedicated to looking at patterns. And yet, we've been taught, we fall to the level of our training, we've been trained to look at letters and numbers and try to decipher. Well, how about looking at a gorgeous image? Right? 70% of all of our sensory receptors, 70% of our sensory receptors are in our eyes, guys. 70%. The way we've been designed, the way our bodies have been designed is to understand things visually, look for patterns. The reason you're here is because your ancestors saw the pattern of the animal in the tall grass and said, this is not safe to be here. It's pattern recognition that got you, and yet we've been trained to not do this. 1/10 of a second is all it takes you to understand a visual scene. 1/10 of a second. 1/10 of a second, is that 100 milliseconds? Am I doing that right? It's almost nothing for your brain to figure out something and understand it. We fall to the level of our training, and we've been trained to look at letters and numbers and try to decipher it from there. Look at this image. Which one do you get immediately? The one on the left, which says, boom. What does that mean? There might be some rocks falling on this road. Be aware. Now, if you saw that image, which you probably did, immediately, you'd have been like, oh yeah, falling rocks, driving, understand it. Versus all those letters, which letters are images on the right side, right? While you're traveling down this road, there's a chance that one or more rocks of varying size may fall from the slopes on one or more both sides of you. You should be aware of this before you travel this way, so you are cautious of this particular type of hazard. Or you could just look at that image and go, be aware. We fall to the level of our training, and the way that people have been trained when it comes to investing is to look at this over here and say, okay, what does that mean? What does that mean? And so people have ended up in the international stock market or the emerging market stock market or the Asian stock market for 8 years, which has been leaking money out of their funds because they've fallen to the level of their training. And guys, it's only getting worse, right? Because we've been trained to look at letters and numbers. Well, between 1986 and 2014, we're getting 5 times the amount of information. We're getting 5 times the amount of information each day hitting us. And the reason I rail against the billion-dollar pick of the month newsletter industry is because they are slamming your brain with more and more and more and more and more and more and more information, more letters and numbers. You want to know why your brain shuts down? Is because you fall to the level of your training. This is not a significant thing. We remember 10% of what we hear. We remember 20% of what we read. And we remember 80% of what we see and do. The brain was designed for pattern recognition, to look at pictures, to look at images, not numbers and letters. That's not how the brain was designed. And when you have a training that was designed about numbers and letters, your money suffers because of it. Okay, so what's the takeaway? Number 1, pictures beat numbers and letters. They tell us everything we need to know, and they can tell us almost instantly. They tell us the flow of money. They tell us where money is flowing. You want to put your money in front of that flow so you don't have to do anything except just be aware of when that money flow changes, and it doesn't change that often, right? Pictures tell us the direction of price, and pictures tell us where it's the safest. We fall to the level of our training. We do not rise to the level of our expectation. We do not rise to the level of our belief about the future. We fall to the level of our training. This is a difference that makes a difference for a lot of people. Hey guys, this is just another step in helping you protect and grow your portfolio and your future. Until next time, this is RC Peck.